Let's start day 2. In day 2 we see this topic: IPO markets, IPO sequence of events, the stock market, supply or demand, price discovery in stock market, traders in market, growth, value investors. Why do company go public? There are number of reasons and reasons can be different for each company. 1. To raise capital and potentially broaden opportunities for future access to capital. 2. To increase liquidity for a company's stock which may allow owners and employees to sell stock more easily. 3. To acquire other businesses with the public company's stock. 4. To make a way for exit to previous investors who want to exit. We see here seed funding. In this there is 5 stage: pre-seed, seed, Series A, Series B. Sequence of IPO. See in photo. Then we see terms of IPO. First, price band. Price band is basically the lower price and the upper price per share with which the company would go public. 2. Issue size. The issue size in a IPO means the number of shares issues multiplied by the amount of each shares. 3. Cut-off price. The offer price at which shares get allowed to investor. 4. Under subscription. This is a condition when the number of shares applied by the PUBLC is less than the number of shares issued by the company. 5. The offer price at which shares get allotted to investors. Dates of IPO. First, open, close date means there are the opening dates and closing dates of the bidding process in IPO. Any desiring bidder can apply or bid between these days. Second, allotment date. Allotment date is when the allotment to the public by the register of the IPO. Third, credit to demat account date. When you receive the credit of the applied IPO shares in your demat account before the listing date of the shares of the company. 4. Refund date. Based on the IPO allocation, the date on which the refund is initiated for the people who didn't get the IPO is known as refund date. How is the IPO listing price determined? Several factors will impact how the good IPO gets listed on the stock exchange and how does it affect the IPO listing price. 1. Demand. Demand for a share makes a huge impact on the listing price of an IPO. Hence, the IPO price is also affected by the market demand of the company. As the higher the demand, the higher will be the listing price. Though growth prospects of the company, the listing price of an IPO is also affected by the growth prospects of a company. For instance, a company that wants to launch its IPO often comes with several objectives like paying debts, operational costs. Teen. Grey market premium. A grey market is a place that is considered under-regulated but often gets highlighted when it comes to a demand for IPO. It is the extra amount investors pay along with the offer price. The OFS, offer for sale, value, an offer to sell an IPO indicates the number of shares that existing investors are willing to dilute in the IPO. Market sentiments. Retail investors play a crucial role in deciding the IPO listing price. As more retailers are looking for an IPO, it further results in deciding the listing price. Supply and demand. Supply and demand moves the market. Demand and supply inversely proportional means demand falls, supply rise, then price falls, and demand rise and supply falls, then price rise. Let's see bearish and bullish market. In the bearish market there is more seller and less buyer. According to supply and demand, here more supply and less demand. Bearish means price moves downwards. Bullish market opposite to bearish market. Next we see type of traders. First one is position trader, then swing trader. Third is day trader. Last one is scalper. Details see in photo. Thank you for watching.